Good evening, everyone. My name is Ludwig Gaines, and I am the Executive Director of the Northern Virginia Apartment Association. And on behalf of our Board of Directors and our entire membership, representing well over 100 members with $2 billion plus of assets in this local market, we are delighted to partner with George Mason University and with NVAR, and it is our pleasure to welcome all of you to tonight's symposium. I see many of our member organizations in the audience, but for those who may not know, NVAA was founded in 1954. It's the local region's premier membership association covering multifamily housing. We represent apartment owners, apartment managers, as well as the vendors who ably service the multifamily housing industry. I will say I'm happy to see the seats filled and so many people watching online. When Eric and I first discussed how we would treat Amazon's potential appearance here in Northern Virginia, we decided we'll wait for a decision. And well, that decision came. And we are delighted. I will honestly say, for our economy, our industry, and the region, this has brought tremendous excitement. It has brought tremendous promise, and it has brought uncertainty. Many of us have many questions, and I think part of tonight's event is to help us answer and navigate what's to come. I will say, and I think this is testament to all of you here in the audience, that we didn't know if anyone would show up. But you have, and we are so excited. Proximity to the holidays, I guess, is trumped by our excitement about the unknown and our desire for answers. We've had our ear to the ground, and what we've consistently heard through all of our members and others, through the media that's called our offices and our members that want to know, is what are we to expect? We put together a panel that I think of local, regional, and national experts that will begin to answer some of those questions for us. And for this, I'm grateful to our panelists who have dedicated their time and their efforts and their energies to putting together their presentations. Thank you. This is the first step in navigating this exciting issue. And for us, we consider you partners as well in this endeavor. So without that, I am the only one between you and the introduction of our speakers and presenters, and I'm going to be quiet despite my prior political election status. I will not be a politician tonight. I will walk and exit stage left, and I will leave it to the experts to share with you all, hopefully, what will begin to be a very important dialogue. I will plug April 24th, which is our Northern Virginia Apartment Summit for those in the multifamily housing industry. We hold it right here in this venue. It is a day-long event we do along with George Mason University. And if I don't get to say this to you personally before we leave, season's greetings and happy holidays, and thank you all for coming.
So now we'll pivot to the impact of Amazon on apartment investment and ownership. To brief us on that, we have Christian Barrero of the Zupancic Group of Marcus and Millichap.
Thank you, Eric. I appreciate that. This is only the second largest crowd I've ever been in front of in George Mason. My freshman year of college, we lost to George Mason in the NCAA men's soccer tournament. Very harsh crowd. I hope you guys and gals aren't as harsh as they were. I would say our presentation today is very conceptual. We're brokers. We're multifamily advisors. We learn through experience. The Zupancic Group of Marcus and Millichap is run by Marty Zupancic. Unfortunately, Marty couldn't be here with us. He's actually at my wedding in Columbia, so I'll be joining him down there Saturday. But I guess I'll do. Who we are, we currently have a $200 million pipeline of investment sales, specifically multifamily and multifamily development. We're working on deals in Tysons Corner, Arlington County, in the Westover neighborhoods and Penrose neighborhoods, as well as we just closed on a 130-unit in Winchester, Virginia. We don't own properties. We help people, investors, buy and sell them. We have 8 agents on our team, full marketing staff, full operations staff, some of whom are with us right now. How we got here, I'd like to thank Eric, of course, from George Mason and the Northern Virginia Apartment Association, and also NVAR for running this event. Our take on things is very, again, conceptual. Doing deals, that's how we get our experience. As it relates to statistics, I think some of the presenters ahead of us had some great statistics on the comparison with Seattle and how that's going to be similar to Arlington and the surrounding metro area. I'd expect over time gradual rent increases on multifamily buildings. This is a 12 to 16-year approach. It's not going to be a bombs dropped and then rents double. We already have high rents in the DC metro area. Growth in other income. I expect parking to become more valuable in the immediate vicinity of Amazon HQ2 in National Landing. There are some owners that we work with right now that they don't charge for parking. There isn't that high of a demand for it. But as 25,000 employees and their families flock to an area, we expect parking to become more valuable. Again, slight drop in vacancy rates of multifamily, stronger absorption rates in Class A properties, and then, of course, the million-dollar question, what's going to happen to my property taxes? We expect property taxes to go up, affecting your bottom line as a multifamily owner. And again, as many of the previous presenters said, the greatest effect that we expect is in the National Landing area, and then a diminishing effect as you get further away from that particular area. 2 brief case studies. First case study. We listed a portfolio of multifamily properties for sale the day that Amazon announced. All 3 of them are under contract. They'll be closed by the end of the year. 2 of which are out-of-market capital, not local investors. 2 of the deals went under contract in the first day. Somebody submitted a full-price offer, no contingencies, and one of which is a cash deal. The third deal is also a cash deal. We expect to see more of this. I'll talk about that a little bit in a couple slides. One of the other case studies I wanted to mention was Uber. This case study really demonstrates the hype effect, the hype wave as we've called it. In 2015, Uber announced that they had purchased a $123 million office building called Uptown Station in Oakland. They were planning to add 2,000 to 3,000 employees in that location. And just with that announcement alone, cap rates of multifamily assets within a 1-mile radius of the location dropped 70 basis points. $10,000 of NOI, that could attribute $200,000 of property value to multifamily investments if it's a 5% rate of return or a 5% cap rate. What ended up happening was Uber did not strategically place employees in that location. They ended up selling that building to CIM Group for a moderate profit, but just the hype alone affected cap rates. It also affected cap rates in Class C properties. As these properties age, cap rates have reduced, and then causing more upside. When there's more upside in a deal, cap rates tend to be lower. Impact on sellers. Again, we expect many sellers to ride the hype wave. I've gotten calls left and right of multifamily owners saying, what's the effect of my property? How should I time the market? Should I sell now? Should I sell in 3 years? Should I sell in 5 years? Really, everybody's situation is different. We always advise clients, well, let's look at your strategy first of all. Are you profit-based? Are you trying to, are you selling because you have to? Is it debt-related? I would always say hype can be very good for sellers because buyers, they want to get into the market. They think nobody else has heard about Amazon coming. The reality is everybody else has. if you wanted to get into the market and hit a home run, it was probably 24 to 36 months ago. You still can get in now because, you know, Amazon hasn't even started deploying employees here. But I would say selling now could potentially be beneficial to owners as we are in a rising interest rate market. Interest rates are roughly 100 basis points, give or take, greater than where they were back in 2017, early Q1. So that's something to keep an eye on. This right here demonstrates the capital migration trends from other regions of the country, just as of third quarter 2018 into Virginia in particular. Just over $250 million. We expect that to go up significantly with Amazon's announcement. As I mentioned in the brief case study, 2 of the 3 properties that we're selling in Northern Virginia right now are out-of-market buyers. We expect to see more of that. I've already gotten calls from agents, investors in Seattle, Cleveland, California, where they've already been through this once before, and they're all very excited to invest in the nation's capital in the metro area. Impact on buyers. Expect to pay higher prices. That's what's going to happen. DC, it's already a very, very pricey investment market for multifamily properties. I can't remember the last time we sold a multifamily asset for greater than a 6 cap. You know, the past 5 deals that our team has sold have been, off the top of my head, 4.5 cap, 4 3/4 cap, 3 3/4 cap, 4 cap, and 4.5 cap. So low cap rates, it's very common. Increasing the bid-ask gap. As sellers want to ride this hype wave, we expect there to be sellers trying to reach for the stars, and buyers, they want to meet them there, but there's going to be an increase in that gap because rates of returns are going to be dependent on interest rates. With those rising, that's going to be an effect. If you're a cash buyer, we don't know many cash buyers that are looking to park cash for 2% rates of return. I wish we'd be doing a lot more business. Lower leverage deals, as I mentioned, we expect more of that, more equity necessary to get into a deal. For instance, the 3 properties we're selling right now, they would pencil out around 60% LTV. Many people want to put as little money down as possible, 75, 80 LTV. You'd have negative cash flow in these deals if that were the case. So we expect higher capital outputs in order to make deals work. Multifamily investment strategies in particular. I think one of the panelists already said this before. We expect an increase in condo conversions. Condo conversions are very much prevalent in DC. We haven't seen it as much in Northern Virginia on a private capital stage, but as home ownership will increase, we expect there to be more condo conversions which should be profitable for owners. Increase in adaptive reuses. There are a number of office buildings that have become obsolete, especially in the Crystal City area. We expect more conversions to multifamily, and we expect more multifamily development and mixed-use development as well. Secondary markets, if you're chasing yield, the meager yield you might get from this area, it would be in secondary markets. It's not going to be Northern Virginia, Arlington County. You're going to be looking at your Fauquier counties, your Prince William counties, your Prince George's counties, which we've already seen are going to have minimal immediate impacts from HQ2, but that would be where you're going to have your best chance of getting the best yield. Michelle is going to speak on affordable housing and the impact there. We were able to speak in October at the Northern Virginia Apartment Association annual meeting about the Housing Conservation District that Arlington County imposed back in December 2017. That's something that was created to try to incentivize owners of apartment buildings in the county to preserve affordable housing. Arlington County's lost over 17,000 market rate affordable units since the early 2000s. Amazon's announcement only looks like it's going to exacerbate the problem even further. And then finally, joint ventures. There are some owners that will say, I don't want to sell. I just want to ride this wave. I want to be an owner. I don't want to deal with the tax consequences, whatever it might be. We're likely to see more joint ventures, especially multifamily properties. Joint venturing with an able operator, an able manager that can become part of the partnership, renovate a property, develop a property to make it more profitable than it currently is. Finally, my recommendations for multifamily owners, investors, definitely seek advisory and brokerage services. We've seen so many times principal to principal, obviously we're tooting our own horn, but we've seen so many times where it's principal to principal where with a economic driver like Amazon HQ2, exposure is key, especially if you're a seller and you want to sell for the highest price. Exposing to the widest reach possible. We're a national publicly traded firm, 90+ offices. It's important to get maximum exposure. If we put a building on the market for sale, the buyer might be out of Seattle. And if somebody calls you and says, I want to buy your property and I'm local, that's great, but you want to make investors compete because that's going to get the highest price, can leave the most amount of money in an owner's pocket. Obviously, that buyers don't want to hear that. Buyers want to get it for the least amount possible. But we've got to play both sides because we represent buyers and sellers. Sellers should consider 1031 exchanges with a trending downwards cap rate effect that we expect. I don't think it's going to be drastic, but there's going to be an arbitrage. If you're an owner and you want to sell, or you can sell for a 4.5 cap, a 4 3/4 cap rate, and you can 1031 exchange and not deal with the capital gains exposure into a passive asset such as a CVS, Walgreens, any triple net lease property, they could be trading for 5, 5 1/4, 5.5 cap, depending on where you're purchasing. There's an opportunity there. You can be making passive income and more income at that. Finally, keep informed on debt markets. It is a rising interest rate environment, so I'd always say make sure you have multiple lending relationships. So if you're going to be buying in a multifamily investment property, you're dialed in on what it's actually going to take out of your pocket, what's the equity requirement to make a deal work. That is all I've got for today. Look forward to hearing some questions in the panel.
Okay, so I invite all of our speakers to come up so we can have a Q&A with the audience for the next 20 minutes or so. If you could please activate their lapel mics. There are 2 mics on either side of the room. If you have a question, please line up on the mic and we will call you. So you can start lining up on the mics if you have a question. We'll start over there.
Hi, everyone. Thanks for the presentation. You talked about the jobs that are being created and people moving to this area, millennials, families, children. Are there any stats or is there any trend line based on Amazon's employee base, who these people will be in terms of like the average family size?
So I guess that,
Any way of predicting that?
is that me? So what I did was I looked at data in the Seattle market and extrapolated based off of what we know about not necessarily Amazon-specific workers, but workers in the Amazon area in specific occupations and industries. And so the distribution skews younger, it's more high-tech, and we have a slightly different average wage because that's what Amazon told us they're going to plan for. So there are, in part of the housing model, there's a large typology of different household structures, and there's not one single one that's necessarily the only one to talk about. So there's a variety and a mix, and I'd be happy to follow up with you later on some of the specifics with that.
Yes, sir.
John Farrell with McCandless and Lillard. I'm curious about Ms. Chapman and the next fellow who was talking. Forgive me, I forgot your name. In looking at your projections of the distribution of the housing that would be generated by these folks, did you take into consideration the fact that we've had a housing moratorium in Fairfax, Loudoun, and Prince William County since 2016? and there's nothing telling us that that's going to change. You can't even get the staff to sit down and talk to you about trying to create more housing. That's part A of that question, but the part B of that question is the large percentage of these jurisdictions where you've got to have an acre or more, 2 acres or more. Last number I saw was 70% of Fairfax requires an acre or more. The numbers are worse in Loudoun, they're worse in Prince William. My intuition is that the distribution we're actually going to see from these folks is not the one that you're showing, but it's going to get skewed into Maryland. And when you skew it into Maryland, now you start asking the people of Botetourt and Louisa County, do they really want to be giving money to Amazon so that the income tax revenue can go to Annapolis? And so I'm just curious about what impact these moratoria are having on your expectations.
I'll go first on this, if that's okay. The forecasts that I did are completely supply agnostic, and it's based on the current distribution of households with jobs in various locations. So the moratorium does affect more the net new supply side of this, and obviously if there isn't housing for these workers to go into, those forecasts won't be accurate. So the reality is then that the workers will have to change their sets of trade-offs, and sometimes that means that they'll change their housing type preference because they don't want to be that far away, and sometimes it means that they will move farther out so that they can get a single family detached that maybe they can't get in Fairfax. And so that's the short answer on the distribution that as I laid it out.
It's an important point, John, and I think that was a theme of my presentation was the lack of supply, but I did mean to mention that, yeah, there is proper reform in Northern Virginia that had an unintended consequence of stifling rezoning applications. And so that came at a time right when it was timely for the development industry to start actually gearing up. We were coming out of a recession, and we had kind of absorbed all the excess pretty quickly, actually, because we weren't that overdeveloped on the residential for sale side. And so right when it's time to gear up and ramp up, this proffer reform hits, the unintended consequences, which stifled rezoning. So that has just exacerbated a supply problem. And I think it may, for the time being, lead to consumers choosing a lifestyle in a more dense neighborhood than they might otherwise have chosen. Michelle mentioned about growth going to Pennsylvania and West Virginia, and that has happened. It has happened in the past, and the 40% or 45% of all housing activity is outside the traditional Northern Virginia of Loudoun, Fairfax, Arlington, and Prince William. But don't forget that, the western Loudoun County, the rural Crescent in Prince William, or Clark County, or Fauquier County are kind of closed for business. They're beautiful, but it's making development leap over them and create a much more harsh commute. So really, it's all those things contribute to a difficult environment. And we're already seeing this year, Maryland is actually, the market's flatter than I thought it would be as far as new home activity. Maryland, though, is up 4%. Northern Virginia is down 4%. Well, Maryland doesn't have some of those constraints, though it's a more difficult regulatory environment as far as how long it takes to get a deal approved. But it's also about $50,000 cheaper on a new home. I mean, so there could be, it looks like there may already be occurring some migration to Maryland given the land constraints in Virginia.
Thanks. We'll shift to the other side first. Go ahead, Matt.
Yes, Nancy Stewart's. Thank you so very much. This has really been fabulous. Help me understand when you're talking about Amazon and where they're going to be living and the impact to Arlington County, how do you see it also impacting the Tysons area close in Fairfax County? I mean, because there's so many apartments and condos and buildings going up there. How do you see them relating to that? Do you think that that would also be a potential for them, for some of the millennials to be living in those areas with the metro being so close to getting them over to Crystal City?
Sure. Yeah, why don't I start? Yes. I mean, the short answer is yes. I think it has increasing appeal, Tysons does. particularly for young people as a lot of new retail and restaurants begins to be developed,
Right.
particularly adjacent to Silver Line stations. At the same time, I mean, we have seen values, both office asset values, multifamily asset values rising within a very close proximity to
Right.
those stations, but there's still a lot of work to be done. I mean, we know Silver Line ridership is not meeting projections so far.
Right.
I think that with these potential new riders, that will probably change over the next 5 to 10 years. I think also as you see the Silver Line Phase 2 get extended all the way out to Dulles Airport and there's better connectivity throughout the region, that will also encourage more young people, well really people of all ages, to consider Tysons as an option. There has been considerable multifamily development in that part of the Northern Virginia market. And so that also makes it more likely that we'll see some spillover of Amazon employees into Tysons.
So that would then be a very desirable coordinated effort between what's happening in the Crystal City area and Tyson's, kind of doing a tie-in.
Yes, I think if the transit allows for it,
Exactly.
which now it does, then that, and you have the restaurant and retail to make it an attractive neighborhood, then yes, I think that allows for a tie-in.
Great,
I would,
thank
I
you.
would say absolutely. I live in Tysons myself, and I'm
Oh,
a
you do?
millennial. So there's a case study right there. I don't work for Amazon. It's a quick shot down to Crystal City, though.
Right.
There's a number of restaurants, bars, lifestyle offerings in Tysons. I guess I technically live in the McLean side. Tysons is more urban, McLean's more suburban. The McLean Metro, like Sandy said, doesn't have the greatest ridership, but I would say that Silver Line, I think it's gonna be tremendous for the area and for ridership into.
Right.
You can't go straight to Crystal City. You're gonna have to transfer, but I would say I would see a number of employees living in that area. There's so many units coming online and that are already online there.
Exactly, thank you.
Yeah, so Christian, you spoke about for sellers, people potentially thinking about selling, it's important for them, to maximize exposure in order to, get the highest price, the highest, best terms, highest probability of close. Can you speak a little bit about the marketing process that you run to achieve, maximum exposure, and also talk a little bit about, your firm's capability to access out-of-market capital?
Sure. I would say, first off, whenever we sit down with a client who wants to sell, we analyze their situation and we customize the marketing process for them. But our traditional marketing process, when we list a property, a multifamily property, we put together a great brochure. We take it out to market for between 30 and 45 days. We also put it into our firm's proprietary, it's called MNet, it's Marcus Millichap's system that connects all the agents in the firm, over 1,500 agents. So when we put it in that system, which is a quasi-MLS for commercial properties, agents from across the country, and we have offices in Canada also, they can blast out our deals to their buyers. Our local marketing consists of us calling, distributing email blasts, postcards to any and all owners of apartment buildings in the DC metro area. We have a proprietary database, our team does, of every owner, whether you own a 4-unit apartment building up to a 400-unit apartment building and beyond. You're in our database, and we reach out to owners or recent buyers that would purchase a property that we're selling. So it's very much targeted marketing, and we tend to generate between 10 to 15 offers on average when we're putting apartment buildings out to the market. So it's definitely a very refined approach that it tends to generate maximum value for clients.
Hi, I'm Kathy Rehill with Remax Distinctive. Thank you for your information. I was wondering, between the forecasted rise in interest rates and the demand, if you can talk a little bit about what kind of growth in resale pricing we can expect. Do we expect a steep curve, sort of a flat rise, consistent, sharp? Can you forecast that at all?
Yeah, so our forecast for the DC metro area as a whole is for roughly flat growth in prices in 2019. Obviously, so this forecast was put together before Amazon finalized their announcement. I think some of the excitement over Amazon coming will increase that a bit. But in general, with the mortgage rates rising, we have seen affordability bite into some of the housing demand. And so for that reason, we're expecting roughly flat price growth and sales growth. But we've come off of, 2017 was a record year, the best year for home sales in the last 10 years that we've seen. So to see a little bit of softening at this relatively high level is still a healthy housing market.
Can you forecast it all beyond 2019 with Amazon coming?
So we only do our forecast out 1 year ahead, but obviously, with Amazon coming, we're going to see the biggest impact in that local area. But as we move beyond that local area, we expect the market to be able to absorb this and to sort of grow in line with the overall economy. So, and I don't know if you've done any more specific forecasts.
We have not done forecasts on appreciation, but one of the things to take into consideration is that the timing of this is going to coincide with some downsizing that's going to occur naturally because of the demographic changes that are on tap for our market. So about 1 out of 5 homes, existing homes in our area, hasn't been on the market for more than 20 years because it's had the same owner. And a lot of those owners are 55 plus now, and there's going to be a little bit of an increase in the turnover. And the baseline for that, though, is that the Gen X is a little smaller, and the millennials are suffering from student debt issues, which doesn't lead to a very intuitive natural cycle that we've seen in the past. So we have other demographic disruptions that would affect this market, possibly even more so than Amazon.
In fact, to build on Jeanette's point about the turnover, especially in 55 plus, that actually does have some significant implications for the multi-housing market because a lot of retirees are downsizing and in fact are looking to move into multifamily units, and they're leaving the 4 and 5 bedroom suburban single-family detached homes. So that actually is beginning to add to the potential demand for multifamily.
The resale home price appreciation has been very weak in this market in my mind. It's been, Case-Shiller would say it's a little below 3% right now, which is baffling to me when there's so little supply out there. So it must be an affordability issue. Any other, there could be a number of things that could be playing into that, but it would be hard to imagine in a rising mortgage rate environment that it would get better than that. But that DC Metro, 3%'s not bad. It's below the long-term norm by my calculations. But it's among the Case-Shiller 20 markets that they track, it's dead last, DED last. So it's puzzling to me. It should be higher.
We tell our empty nesters, sell. Don't wait for a long time. Sounds like.
Yeah, I mean, inventory is low, so any additional inventory that goes onto the market, particularly if it's close to that median price point, is going to sell very quickly.
We'll take the last 2 questions on this side. Go ahead, sir.
Oh, hi, Paul Bergeron from National Apartment Association. Maybe I missed it, but is there much of a market for single-family rentals? There seem to be companies that are emerging that are purpose-built for housing that they're going to rent. And are there buyers coming in who are looking to buy houses in this area, the sole purpose of renting them out?
Sure there are.
I would say, I think that product type probably appeals most to Amazon workers who may be coming into this market from outside the region and are in a transition period where they're trying to figure out exactly where they want to live or which school district they want to send their kids to, and then probably 1, 2, 3 years down the line, they would end up buying.
Yeah, and I would add, this area is known for having some transient workers with the Defense Department here, the State Department here. So there is a healthy single-family rental market to serve, those types of renters. So that already exists, and we'll probably be able to easily absorb those transitioning Amazon workers.
Last question.
Yeah, so my question is, many of you alluded to a recession in the short term. How would that impact housing in Northern Virginia? The last recession had a significant impact in Northern Virginia compared to the country. So yeah, sorry to close on a sad note, but.
That's the deal.
That wasn't the question we had requested.
We're going to need another last question.
So the DC metro area, from a housing perspective, actually did better than most other parts of the country during the last recession, in large part because the government was here and provided a countercyclical boost to the economy. That said, there were still areas, particularly in the outer lying suburbs, that were very hard hit by the last recession. Housing played a big role in the last recession. There was a lot of speculative building, which we don't see now. There was a lot of mortgage activity that is very different than what we see now. So underwriting standards weren't as high, documentation standards weren't as high, so that's different now. And I already mentioned the overbuilding versus underbuilding. We've been underbuilding not just for the last year, but essentially for almost the last decade. So it's a very different environment that we're in now versus before. Obviously, when you have an economic slowdown, housing is driven by economic fundamentals. People have to have income and believe that their jobs are secure to get into the housing market and make a for-sale purchase, which they're spreading out and financing generally over 30 years. So that's really fundamental to economic activity in the housing market. And if we see an economic slowdown, we will probably see somewhat of a slowdown or softening in the housing market. But because we're in a very different situation this time than before, the effects this time will be much, much different.
Let's end on an upbeat question.
I'm the wrong question.
Oh.
Okay, sorry about this. For the economists and those analyzing data and looking for leading indicators of potential market change, is the current bond yield curve inversion giving anybody angst that you can talk about? Would
It's
like
not
to share?
inverted, yeah.
Well, it is in the 2s and the 5s, or something in the smaller notes.
That's right, though generally people look to the 2 and 10
Yeah.
as a much more reliable indicator of recession.
It's a yellow light, not a red one, I think, but I'd like your opinion.
So anytime you have a flattening yield curve, that suggests that there's a little bit less optimism about long-term prospects for growth versus what we're seeing today. I mean, it's natural to expect growth to slow when we've been, the economy has been growing beyond its potential. So GDP in the last couple quarters has been 3.5%. That's above what most people believe its long-term potential growth is. And so it's reasonable to expect that we would see a bit of a slowing in growth. Just because we have a slowing in growth doesn't mean we're moving into a recession. There's been a lot of talk about a recession coming in 2020. And it does make me wonder, if everybody's expecting it, is it really going to happen? I don't know. We'll check back in a couple years.
Just to add on to that, we're in the second longest business cycle going back to 1850s. And so as that business cycle ages, it just runs out of potential for that large percentage increase of gains. And so those growth rates just taper down a little bit.
So please join me in thanking our panelists. We'd like to invite you to our next event on February 7th with the AIA, District of Columbia, for Designing Extremes, Building a Resilient City, on hearing from weather experts, designers, and developers on new strategies on building for resiliency as the next project amenity and competitive advantage. On behalf of George Mason, the NVAR, and NVAA, thank you very much for attending.